Right. Okay. Hey, so are you on the Better Ask Jay podcast? It's a business entertainment stream for business owners, startups, and taxpayers in the UK. You have to know you are not alone in your fight with HMRC and tax issues for you and your business. You have friends and experts on your side you can rely on. Better Ask Jay. And I'm Maria, business development expert for you today. Let me just introduce Jason Seagrave, tax expert and business owner who helped more than 400 businesses, can you imagine, to reduce their tax and run business in a smarter way. Hi, Jay. Hi.
Hi there. Hi, Maria. Good morning. Nice to see you. My name's Jason Seagrave. I'm the founder of Seagrave French. We're an accountancy practice in Nottingham. And as Maria said, I've helped hundreds of clients with their tax and their accounting. And my main job is to make sure their compliance issues are taken care of and keep their tax as low as possible within the law so that they can pay the least amount of tax legally, but they can sleep at night. So
Right.
recently I've had a difficulty with my right eye, so I had to have an operation, and I've been out of action for 3 weeks. And for the first 2 weeks, I couldn't actually do anything apart from lay on my front. So all I was doing was all I could do was listen to podcasts. And because of the way my brain works, there I was listening to podcasts, and I suddenly thought, we should do a podcast. Like, wouldn't it be good to do a podcast? We've got so much to tell people. We're a really proactive firm of accountants. We try to innovate, and so we've got so much news and so much advice. We should do a podcast. So that's why we're here. So welcome to the podcast. It's called Better Ask Jay, and I hope you like it.
Yeah, brilliant. So, and let me give me a clue why Better Ask Jay. Why this? Why this form? So, is it like any reference to something?
Well, it's a little bit naughty, but yes, I quite like the series Breaking Bad and the spin-off episode from that. And in my ideal world, I sort of would like to see myself as a Saul Goodman type character, but I think he operates a bit too close to the line for me. But we wanted to give it something that was a little bit out of the ordinary. So instead of better call Saul, it's Better Ask Jay.
All right, brilliant. So, that's really sounds like a fun, yeah. And in our podcast, we're going to talk about the last news, which, in our opinion, can influence in your business, and of course, how you can handle with it, and kind of benefits you can get from that. And we will definitely got fun because we will have other two sections where we're updating with the Jason Seagrave firms. Sorry. I'm sorry, I'm a bit nervous, but where we're going to update you guys what is going on in our practice and how we are dealing with the challenges from our clients. And the more treasurable part of the podcast will be a Q&A section. Basically, we did a good home task jobs, home job, because we collect all the questions from our clients and from our prospects, which they are really worried about. And at that section, we're going to give you an answer on all that questions. How does it sound, Jason?
That sounds great, and the idea is that in the future, as the podcast gathers interest, that we will actually receive emails from people who are watching who've got specific questions, and we'll answer them in the answer section. So our email address for that is betteraskjay@gmail.com. So if you've got any questions about business or tax, send us an email, and maybe we'll answer your question on the next episode.
Oh yeah, that sounds really, really prospective. Right, let's start to have a fun. So I would like to move to our news section. So this news for this week, we got this capital giant tax news. Yeah, so annual allowance has been reduced by 3/4 recently. previously it was 12,000 pounds, and now cut down to the 3,000 pounds. So, Jay, what does it really mean? Could you please explain what CGT is and what is the annual allowance? So, could you just make it more clear for the, for the business
Sure.
people?
Yeah, sure. So if you sell an asset, for example, a rental property, or some shares in a company or something, you have to pay something called capital gains tax, and it's normally calculated on the difference between what you sell it for and what you bought it for. And the rates are relatively high. So for a rental property, it's 24% of the gain that you've made. Now, previously, you could make £12,000 worth of gains in any year and not pay any capital gains tax. So that was quite a good relief, because if you've got a husband and wife together, they've got £24,000 worth of relief that they can have against their gains. So we often found that if people were selling shares or properties they hadn't held for too long, they wouldn't have any capital gains tax to pay, which was brilliant. But unfortunately, HMRC have identified this as an area that they've targeted, and they've reduced this amount from £12,000 to £3,000 in this tax year. So you're now not getting as much relief. So effectively, you're paying, if you've got a capital gain, you're paying tax on an additional £9,000 this year to what you would have done if you'd done it a few years ago.
Right. So is it like any other ways how you can, handle this challenge?
So we always like to not just give you a problem, we like to give you a solution. So we definitely have a few ideas for this. So the first thing is that you pay the tax at the rate of your highest, dependent on your highest tax rate. So if you're a high rate taxpayer, then for rental property, you pay 24% tax on any gains. But if you were not a high rate taxpayer, you would only pay 20%. So there's a way that what people are doing is reducing their other income in the year that they sell an asset. Because if you reduce your income in that year, then the rate at which you pay capital gains tax is reduced. And one way to do that is to make pension contributions. So what you could do is you could sell a property, be worried about the capital gains tax figure, but reinvest some of that money in a pension, and that would reduce your income and reduce the tax rate at which you pay capital gains tax. So that's one good way of doing it. Another would be, if you've got things like shares, is to split that disposal over a number of years. So the allowance used to be 12,000, but it's now only 3,000. But if you're selling, some shares, sell one lot on the 31st of March and another lot on the 30th of April, and you'd have got 2 years of your allowance there. So you'll get 6,000 as opposed to 3,000. And then another one is, if you're not using your capital gains tax allowance in a year and you've got some shares, then maybe think about selling those shares to utilise your capital gains tax allowance in that year, but then buying them back straight away through your ISA. So you actually still have the shares in your name. They're in an ISA now, which is tax free. So any future growth is there'll be no capital gains tax on it, and you won't have paid tax or you've paid less tax on the disposal. So that's another way of doing it. And then finally, if you've got jointly owned assets between spouses, don't forget that you've got 2 lots of allowances to use. So and because you can transfer things between spouses at a late stage. If you've got a disposal coming up, you could transfer a property into joint names prior to selling it, and you get 2 lots of the £3,000. That used to be a lot better, because it used to get 2 lots of £12,000. But there's 4 ideas. As with any of this stuff, you really need to take professional advice directly. So pick up the phone. We offer a free initial call. We'll talk you through it. Don't make decisions based on the contents of this podcast. Just here to show you that we do have ideas, and we'll explore them with you once we speak to you directly.
Okay, wow, it was really interesting piece how to reduce this. stuff, but let me just move forward to the next news. So UK coming out of recession, that's really loud kind of, yeah. But the UK GDP increased by 0.6% in the quarter. Does that really mean that the UK is out of the recession? How do you think, Jay?
Well, technically, yes. Basically, the technical situation as far as whether we're in recession or not is if you have 2 quarters of declining growth, then we're in recession. So the fact that we've got a positive figure of 0.6 means that we are out of recession. But it's a very small percentage. It's 0.6. There's a lot of margin for, if you think about how complicated calculating inflation is, to only have just got over 0.6%, it's a very tight as to whether it is or isn't coming out of recession, because it wouldn't take much for that to have been lower, and then we'd be in negative, and then we'd still be in recession. But there are other, we have seen inflation reducing over the last few months, which is good news. Finally, at last, the inflation is reducing, which hopefully in the next few months will result in a reduction to the interest rates, and that will be a welcome benefit to all of us with mortgages and all of those businesses with borrowings, who will hopefully see their interest costs come down. So I think it's positive. It's just a little bit tight for my liking. It's just very, very slim. We're very slimly into this positive situation, but nonetheless, technically, we are out of recession, so we're heading in the right direction.
I see, right. So, and all this, there are so many factors which can influence on it, and that's really takes slowly, but that's positive stuff with which we are just, coming out of the recession. So let me just be more positive about that. Yeah. And let me just move forward to this, renting rates inflation issue, which we have at the current moment. So the increase in rent in the latest statistics shows an annual increase of 9.2% on top of an increase of 9% in the previous year. This is against a drop in the value of houses prices. So, Jay, let's discuss why this is happening.
Okay, yeah. So we have a lot of clients who have their own properties who rent them out. We're a sort of specialist in the property area, and unfortunately, over the last few years, the government have really sort of taken a dislike to those people who have got property portfolios, and they've introduced taxes which have been really painful for those people. So, if you have a mortgage on your rental property, you used to be able to get full tax relief on that, but now if you're a high rate taxpayer, you don't. You only get relief at 20%, and this has been really tough on landlords, because they're getting their rent in, they're paying their mortgage repayments, and they're paying tax on the difference between their rent and their expenses, and that deduction has got smaller and smaller, and so now you've got people with large portfolios that are highly geared who aren't making any cash flow out of these rental properties, and so what's happening is these people are thinking, well, I'm not going to do this anymore. It's not worth it, and so they're exiting the buy-to-let market, or they're having to put their rents up because it's not affordable. So we think the reason that the government did this was that they were hoping that it would put more supply of housing into the market, because maybe the landlords would sell. But the problem is that if they sell, they'll crystallise a capital gains tax charge, like we've just spoken about in the previous section, where where they're paying more capital gains tax. So a landlord's looking at the situation and thinking, right, I've got this property, I'm barely covering enough money to pay the mortgage and the tax on it. What do I do? Oh, I sell it. But if I sell it, I'm going to end up with a big tax bill. So the only option is to put the price of the rent up. So the consequence of this action by the government is that rents are increasing, and there's a reduction in the supply of rental properties, which of course puts up demand. 18% increase in rent over 2 years. That's a big increase for tenants to have to find. And unfortunately, I have to say I lay the blame clearly at the door of the government for this one. They've got this wrong. And I need to tackle it, otherwise it's going to get worse.
Right. That's quite, that's quite scary, isn't it? How such type of the politics can influence the life of the simple people who are paying just more and more. There is no end of this list of requirements.
Yeah.
Yes. And just recently, the last week, we got a really good case, and I would like to hear about this case about how people are trying to reduce the tax when they are, buying the property and making this limit, put them in the limited company. Can you just slightly tell me about this case, please?
Yes, so it's a little bit complicated, and it has to be handled very, very carefully in order to comply. Because one of the solutions is to put the property into a limited company, because at the moment limited companies still get full tax relief on their interest charges. Mm-hmm. So if you put a property into a company, then you'll be nice and you'll pay less tax. The problem is that if you sell the property, if you transfer the property to the company, it's technically a disposal. So if you don't do this properly, you'll end up with a capital gains tax computation to pay. Now, for some people, it's still worthwhile, even paying this, if they can afford it, to pay this capital gains tax now is worth it, because they'll save so much money having the property in the company. But for others, they haven't got the funds to do it. There's also stamp duty to pay as well. So it's effectively a transfer of ownership. So the company has to pay stamp duty. So there can be quite high costs of transferring properties into a company. So our first recommendation is, if you're going to buy a rental property, put it into a company from the start, because you'll be more tax efficient. If you've got a portfolio of properties, and the sort of magic number is between 5 upwards. If you've got more than 5 properties, then you can do what's called an incorporation relief, and basically you can transfer the properties into the company and not pay the capital gains tax. The capital gains tax is rolled over into the company, so that when the company sells them, it pays the capital gains tax. So it's quite a nice way to get them into the company without having this huge liability. Now, you do have to be very careful with it, because HMRC are all over this. So if you're thinking about doing that, you need to get in touch with us to make sure it's done properly. So we'll work with you and your solicitor to help you move that into a new company. But it's definitely doable, but you have to be extremely careful.
Okay, thank you. It was really, detailed. Okay, so this week was not only rich with all this business news. It's quite, rich on, I think, on your side. So what kind of you guys was up on this week? Can you just tell me, give me just open this curtain, for us how you spent that week?
Yeah, so before we get on to the serious stuff, the staff, all of us went out for a nice evening on Saturday night. We went to a cowboy disco in Nottingham city centre, and everybody enjoyed themselves, even those people who didn't think that they were country music fans. They've been listening to country music in the office, and so we had a fabulous time. We had a little bit of a dance, lots of free swag we picked up, a few drinks. Nobody misbehaved themselves. We had a really, really nice evening, and it was good. And one of our new staff members, it was the first time she'd been out with us as a social thing. So it was nice for her to get to know us in a more informal basis. And she'd never listened to country music before, and she really enjoyed it. She even knew some of the songs. And my tip is that I think country music is going to continue to become cooler over the next year. And I said to her, when all your friends are saying to you, "Oh, country music's great, isn't it?" You can say, "Oh, I was dancing to country music a year ago. I'm really cool." So yeah,
Right,
that's my
I
advice
think.
to her.
Oh, thank you for sharing. I think that will be a portion of photographing your social media about that, and yeah, so you can
Yeah.
enjoy. Right. So I got just a gossip, from one of the tweet. Let me say that there is a kind of a battle on your office about the radio. So let me say, if some new staff arrive on your board, they don't have a choice but just to listen to the country music radio station. Is it true or not?
Well, yes, we do. We do listen to the country music station quite a lot in the office, but we have said to Latvia, it's okay. You can change the station if you like. So she's younger than most of us, so she was listening to. She puts on some noughties music. So we're mixing it up. But yes, she certainly had an initiation into the country music scene in the first few weeks.
Okay, right. That's nice to know. Okay, that you're not dictator in this meeting. You're not.
No.
Okay, great. So what's I'm chasing now some really nice cases. Can you just share with me what kind of clients did you got from the last week? So probably just in a general. I do understand that's a kind of privacy stuff, and people don't want sometimes that somebody talk about their business. But let me say that we can find such much in the common. So just tell us a nice study cases here. Can you share something?
Yeah, sure. So we no names, of course, but we had a couple of things this week. One is a really positive one. One is something that's troubling a client, which I'm hoping that we can help them with. But the first one had a lovely lady, come to see me. She's got some rental properties, and she's thinking about what happens when she's no longer around, passing these properties to her daughter. And at the moment, if she doesn't do anything, she's looking at quite a substantial inheritance tax bill, or the estate is. So I think we looked at this, and we put a plan together using a limited company, without going into too much details. We'll transfer them into the company. Now, she will have these costs that I talked about, these transfer costs of capital gains tax and stamp duty, which will be substantial. But once the properties are in the company, we found a way for her to continue to draw the income from them while she's still alive. So she's still going to maintain her lifestyle. But the longer that she lives, the less inheritance tax that she'll pay. So we've worked out that if she lives 10 years, she's going to save something like £1.2 million worth, or the estate is, of inheritance tax. And if she lives 20 years, the estate's going to save £1.8 million worth of inheritance tax. And it's nothing sort of particularly fancy. It's just using the rules that are there at the moment to transfer these properties in. She's paying the right amount of taxes as she does the transaction, but it saves her a fortune, because we're basically putting these properties into the company, and any future increase in their market value, there's no inheritance tax due on it. Whereas if she left
brilliant, isn't it?
Yeah, if she left it where they were, and in 20 years' time, they'd have a huge bill. So that's a brilliant bit of news. She was very happy with that, and so that's a bit of
I
news.
bet her children is quite happy about it.
Well, I do have to explain it to them first.
Right.
But yes, I'm sure they will, because it's a difficult one, because inheritance tax is something that the children or the beneficiaries are very keen on, and sometimes the people that have the assets are sort of thinking, well, I don't want to spend money now to save it on inheritance tax because I'll be gone then. So it's a difficult one sometimes. We sometimes get pressure from the beneficiaries, but in this case, she was very keen that she wanted to make sure that she said to me, I don't mind paying 25% inheritance tax on my estate, but I don't really want to be paying 40%, which is the top rate of inheritance tax. It's pretty sickening. You work all your life, you pay tax, you accumulate some assets, and then you have to pay 40% when you die. So you think about it and you think, well, hasn't HMRC had pretty much all of that money now by the time they've had the last 40%? So it's a big one.
Yeah, so there are two types of people on this earth. Yeah, so some of the people are really care about such type of the issues. I mean, they are ready to pay for their own funeral service now, rather than to claim it from their children or relatives to pay for that. But some of the people really don't care. So there are two types of the people, So that's one of the way. That's really nice. So what about probably you have some other different case to share with us?
So this is an early case that I'm helping somebody who got a bit of a problem, and I really, the point I want to get across really is that we're sort of seeing very aggressive behaviour from HMRC on this. So again, without giving enough detail to sort of identify the client, he's been selling stuff on eBay, his own personal goods. So he might buy a computer. He likes to have the latest stuff. So after a short period of time, he buys a new computer and he sells his old one on eBay. Well, as part of a campaign that HMRC are running together with the online marketplace providers, HMRC have got hold of details of the income that he's had on eBay. And it is unusually high for someone doing it personally, but basically they're saying, right, well, you've done all these sales on eBay, and he said, well, I have, but I haven't made any profit because I might have bought a computer for £1,000 and then I sold it for 500, and he's given them examples where he's bought something for £1,000 and sold it for £500. But he can't provide this information for the whole period that he's been doing this, because as far as he was concerned, he wasn't running a business. He was just selling a few bits and bobs online. So he wasn't obliged to keep his receipts for all these transactions because he wasn't self-employed. But HMRC really seem to have got their knickers in a twist with this one, and they're sort of really being very hard about it. And they said, well, we need you to explain every single transaction you've done and prove that it was sold at a loss. Well, he doesn't have that sort of information. And in the absence of that information, they've just raised an assessment for 5 years worth of tax. So they've basically calculated what they think he should have paid in the current year, using some ridiculous assumptions. So they said that only 20% of his income would have taxable deductions, and they're taxing the rest, 80%, and then they've applied that for the last 5 years. So this man, who's never made any profit on his online marketplace, has got a £15,000 tax bill at the moment. Now we're helping him, and I'm confident that we can sort this out for him. But without professional advice, he doesn't know what to do, because they just come
that's
too far.
absolutely ridiculous. I'm sorry. Should I be worried that if I buy some new shoes, really nice and luxury, and then I will come up with the idea just to resell the shoes because it's not suits me well, So on what point, let me say, I should to be worried and aware about this income from the eBay and other marketplaces, because they are targeting probably for some specific numbers there, are they?
Yeah, so this guy had quite a high high turnover for personal use. But if you're selling more than a few £1,000s worth of stuff in a year, then I think our advice now, based on this new attitude, is to if you retain receipts for things that you've sold, just so that you can show that it didn't cost, that you've made a loss on the disposal, because they're being very firm with this. It's it's very,
right.
very, very, very worrying, because he's asking to pay tax for profits he hasn't made, and who can afford to do that?
Exactly. But let me say, so they definitely, HMRC are up, with a new scheme how to targeting people on this Amazon business, eBay business, and other platforms, because they think that they are missing something there and they can get more from the people, on that platforms. And it wasn't a really representative case of how they are doing. Right. Thank you for sharing. And now I would like to move on to the best, on my opinion, treasurable sections for our clients and for our prospects and for the public. That's a Q&A section. So as we mentioned before, you are more than welcome to email to our betteraskj@gmail.com any questions you have and which is bother you, and we will be try to give you the full answer on our podcast. So the first question is we got the first question from our client, which is how much should I be saving for tax if I have my own business? This is quite general, isn't it?
Yeah, it's a really good question, and it's actually one that I cover anyway in my initial meeting with clients, because it's very important, and I've seen people come a cropper with this. So if you've been previously employed, it's a little bit of a surprise, and it's difficult to cope with the fact that all of a sudden you're getting your income gross and you're having to pay your tax at a later stage. So if you started your business now, on the 16th of May, you wouldn't have to pay the tax on those profits until the 31st of January 2026, which is nearly 18 months away. So but when you do get to that period, you'll have to pay 18 months worth of tax all in one go. So it's really important that as you're earning your money, you're putting away a percentage to save for that tax. And then when the bill comes, you'll have it put aside. So it depends to some extent which structure you've got, whether you're a limited company or a sole trader or a partnership. And it depends on the level of your income. But generally, if you save, so the way it works for tax is you take your income, your sales, and you deduct tax allowable expenses from that, and that gives you your profit, and you pay tax on that. Now, if you're a company, you pay 25%. If you're a self-employed person, you pay 20%, but you also pay national insurance on that as well if you're a self-employed person. So if you save 25% of your sales every month, then by the time you come to pay your tax, you will have plenty to pay any tax that is due. You'll probably have overdone it. You'll probably have some spare, but in the first year, it's a good idea to over save, because until you've got the first year out of the way, you don't really know how much your expenses are going to be. So put away 25%, and you'll be fine. You'll have plenty.
Right. Okay. Great. So let me just, to use this podcast for myself just a bit, because I just set up a new business for myself, and I have this every 19th of each month, I can claim, some expenses against my tax. Let me say in this way. Mm-hmm. So the question is, what expenses can I claim against tax?
Okay. Well, it's there's a lots and lots and lots of case law about this, lots of rules about what you can claim against tax. There's actually a handy guide on our website which goes through it in detail. So we'll perhaps put the link up on the podcast so that you can have a direct link to that, and that goes through every single expense that there is, because it'd be too long for me to cover every single thing. But generally, common sense is the main thing. So if you think it ought to be tax allowable, then it probably is. There are a few exceptions. So, for example, business entertaining is not allowable. So if you take out a client or a prospective client for lunch, or you take them for a round of golf, or you take them to see a show or something and they try to sort of butter them up to get them as a client, most people would think that would be allowable for tax. And that is one of the things where I say mostly it's common sense, because that seems like it would be allowable, but it isn't. It's specifically excluded. So if you make those sorts of expenditures, they're not allowable for tax. But everything else that you'd expect to incur, I think we've got a question later about cars, so I'll deal with cars later. Because they're a little bit more complicated.
Oh, yes, let's stay away from the car now.
Yeah. And then in terms of other expenses, travelling expenses, so if you use a toll, if you pay for parking, if you have lunch when you're out on the road, all of those things, they're allowable. There's a few people think things like uniform, clothing is allowable. So they think, if you're an accountant, you have to wear a suit. We don't wear suits anymore, but in the days when we used to wear a suit and a bowler hat, they think we'd be able to claim those back, but they can't. There's specifically rules about that say you can't claim back clothing unless it's protected clothing. The case law refers to the fact that the suit has two uses, or more than one use. Yes, it's there to present a professional position by wearing a nice business suit, but it also keeps you warm, and it also keeps you modest, so that you're not completely naked when you're having a conversation with somebody. So because of those two other things that it does, that isn't allowable. But if you have to wear overalls because you're getting plaster all over you, and work boots, that's protected clothing, and that's a different matter, and that's allowable. So I think the summary is generally it's common sense, but there are a few weird and wonderful exceptions. But have a look on the link on the website to find out about that. And the way we do it with our clients is we say, look, put everything through you think might be allowable. We'll review it, and if there's anything that you can't claim, we'll disallow it, and probably we'll also come up with a few items that you haven't claimed that you are entitled to claim for. So don't get too bogged down with it. Put everything down, and your accountant, if you've got a good accountant, will make sure that you're only claiming for the things that you can claim for, and to make sure you're claiming for everything that you can claim for too.
Okay, right. Thank you. And let's move with another question, which is like really common, really, let me say, that's a kind of common question from the public. I got probably every week. And this specific lady, she's asking, do I really need an accountant? Can I do everything myself? Such type of the worry people have. So what do you have against this statement?
Yeah, well, first of all, there are certain things that you can't do if you're not an accountant. So if you've got a limited company or a limited liability partnership, they have to be submitted to the authorities in a certain format. And that format is only available to accountants through the software that they use. So if you've got a limited company, you're going to have to use an accountant to submit that. So that's the first thing. If you're self-employed, it is called self-assessment, the tax regime. And the idea in 1996, when it was introduced, was that it would allow taxpayers to do their own tax return. So you can do that if you want to save a little bit of money. You can do that, but I would recommend using an accountant because for a number of reasons. One is they will make sure that you don't do anything wrong, that you don't claim for anything that you shouldn't be claiming for. They'll also make sure that there's nothing that you've missed. So a good accountant really ought to pay for themselves in terms of what they save you in tax should cover whatever their fees are. So having an accountant versus not having an accountant I think there's an advantage to it in terms of you have a net benefit in your pocket. And then the third thing is I'm a great believer in doing what you're good at. And, I'm not very good at DIY. So, if I need some painting doing or something doing like building, then I'll ask someone to do it because I'm going to take longer than they would to do it. And it will probably be a disaster. It's far better for me to go and do somebody's tax return for half an hour or an hour, earn the money and pay the person to do it properly. And that's what I sort of advise my clients to do. Don't be going home after a hard day's work, spending hours doing your bookkeeping and your tax returns. It will take you far longer than it would take us to do. And in that time, you could probably earn the money that you're paying your accountant to do it. And so, think about doing the things that you're good at rather than just trying to save a few pounds. So I think for those reasons, you don't need an accountant for everything, but I suggest that it's a good idea to have one. And if you're going to have an accountant, definitely have one who is a qualified accountant. There's no regulations stopping anybody setting themselves up and calling themselves an accountant, which is unbelievable to me. But you don't have to have any qualifications to call yourself an accountant. So first question to ask if you're talking to an accountant, what are your professional qualifications? That means that these people have been trained properly. They're regulated by their professional body. Somebody's checking their work. Somebody's checking that they have insurance. And so it gives you a bit more peace of mind.
Right. Yeah, I'm really with you about this point, but I don't believe you that you are not good in the DIY. So I don't know what type of the people tell you this. Well, I can't believe on it. But anyway, that's kind of.
I did decorate this office when we bought this office. I did decorate it, so I can do it.
Well, you can do that, but the question is for me, that's let me say two things: money and joy, and fun. What I can get for this 1 hour. So basically, I'm an expert in specific field, so I'm doing business development. If I can do that with the fun and when I can enjoy and when I get my result quickly, and with success and got this drive on my work, this has really inspired me. But I can't do this accounting job, which is for me absolutely boring. It just will kill me in one day. I will be dead body after, and I will be just, to be honest, in my life, I faced with the difficulty that I should to have it with my own because I was shortage of the sources or with the time, and let me say, it's not makes me more happy. That's the main point, isn't it? If you are kind of put yourself in the position when you should to suffer rather just to let it go, this really reasonable amount of the money. I don't know. I definitely about to let it go and just to be happy. That's my point of view, right? This statement when the people are really scary about the HMRC and let me say, what happens if I get things wrong, if I will do my accounting, with myself, which is like fulfill the form of tax return or something. So what happens if I get things wrong? HMRC seems very scary. So what you can give advice on it?
Yes, it's like anything that you're not used to dealing with. HMRC do seem to be quite scary, but they just need to be put in their box. Sometimes they don't have any power to be the judge, jury, and executioner when it comes to a taxpayer. So, in the same way as the police have things that are, protect the public so that they can't just do whatever they like, the same thing applies to HMRC. And unfortunately, some of the guys at HMRC sometimes forget this. The first thing to say is don't worry, you're not going to prison. For the normal tax situation, it's all done. The attempt is to try and get things correct. There may be some penalties and there may be some interest, but don't keep yourself awake at night thinking that you're going to be going to prison. But if you do get an inquiry from HMRC, and if you haven't already got an accountant, that's a time to speak to an accountant who can sort of stand in between you and HMRC and deal with them. And we talk the same language, and we'll help to come to a resolution that suits both sides. And I think it's fair to say that HMRC probably do take advantage of taxpayers who don't have any advisor, because they're easy prey.
Oh yeah.
So yeah, you need to be careful there. So if it's starting to get nasty, and get an advisor in. This guy we talked about earlier, we didn't do his tax return for him, but we're quite happy to help him resolve it with HMRC. So don't panic, speak to an expert, and we'll get things sorted out. If you have got any, if you have made a mistake or you've forgotten to declare something, then the other advice is go to them first. So, go to an accountant and say, look, I've got this rental property. I haven't declared my income on it. I'm worried that I'm going to get caught. What should I do? And the penalties and interest will be far lower if you go to them and tell them about it, rather than them having to come after you and sort of force you dragging and screaming to pay the tax. So, if you're worried about that, speak to us, and we can help you settle that with HMRC.
Yeah, that's always good to know that somebody stand by you and somebody can, using their expertise and to protect you against such type of the things in this life. That's really good, isn't it? So, by the way, I know that exactly your company provide the complimentary consultation for the prospects and clients. Is it really true?
Yes, we offer a free 90-minute initial meeting to everybody, and that can cover anything. If you're a new client, we'll explain to you how things work, what you can expect as a taxpayer. If you've got an inquiry going on, we can talk you through how that would work. We have those 90-minute meetings.
That's
there's a link on our website to.
Yes, sorry, Jason, I'm just a bit interrupt you because that's kind of, is it a common things that the accountants do in the UK, 90 minutes complimentary consultation? Because I heard another this gossip about this timesheet that the accountants really precisely charge you by the hours. So the first let me say, myth about accountants in the UK, are they all do this complimentary consultation, for 90 minutes? Is it true?
I don't know that everybody does it. I think you're right. It's quite a sort of old-fashioned profession, accountancy, and they record the hours that they spend on jobs. So if somebody spends an hour and a half talking to a prospective client, that affects their non-chargeable time, as they call it. Well, we don't do timesheets. We haven't done timesheets for 15 years because what we like to sell is outcomes, not time. So just because I spent an hour working on your job doesn't mean I've done anything to your benefit. So, but if I've done your tax return, then I've given you an outcome. So we provide our clients with outcomes rather than charging them for time.
Okay.
So that's the first thing. I don't know. I don't think many accountants offer that free initial meeting. But you have to. It's a big thing. It's a very important relationship. You're having an accountant, and you have to be comfortable with each other. And so it's really important to have that initial meeting to get to know each other, because we like to have long-term relationships with our clients. So we don't want to be forming a relationship with someone that doesn't fit with us. So because we're quite a sort of innovative, young, creative organisation, and some people, they want a traditional type of accountant, and that's fine. And but that's not us. So
Right. Okay. I see. And I have, I got this question for myself as well, but I think that's a kind of, a lot of people are really interested about how to do that. So I use my car, in my business. Can I claim it?
Yeah, well, yes and no. It depends. Is the answer.
All right.
So if you're a sole trader or a partnership, then yes, you claim the full cost of your car, a contribution towards the capital cost, all the fuel, all the insurance, the tyres, the servicing, the MOT, everything that you have on the car. And you add it all up and you put that cost through your self-employed business, and you disallow a private proportion. So you say, right, I'm doing 10,000 miles a year, 2,000 miles of those are private, so I'm going to disallow 20% of that cost. That's really straightforward. If you're a limited company, it's a bit more complicated, because yes, the company can pay for your car for you, and it can claim all the expenses against its profits. But as the recipient of the car, the employee has to pay tax on the fact that they've been provided with a company car. So, and that's for petrol and diesel cars. That's very expensive, because it's a percentage based on the list price of the vehicle. And as car prices have increased, so even a relatively sort of not a luxury car now is going to be £20,000-30,000, and your taxable benefit on that could be 25%. So you're paying tax on £7,500 to have for the privilege of being provided with a car. So if you've got a petrol or a diesel car, it's not a good idea to put it through the company. Instead, you make a claim for the mileage, and you can claim 45 pence a mile for the first 10,000 miles in a year, and 25 pence per mile after that. Which is not a very good rate. It's been that way since I was 18, and I won't tell you how long ago that was, but that's a long time. And I remember that fuel back in those days was 49 pence a litre, and it's three times that amount now. But the monthly the mileage hasn't increased. So it's a bit of it's not great for companies. So that's one of the sort of things to think about with company cars. There is a bit of good news though. If you'd like an electric car, you can put those through the company, and the benefit in kind is very low. So instead of it being 28% of the list price, it's currently only a few percent. So your tax on being provided with a company electric car could only be a few £100s in a year, and the company can claim all the costs of it. And in fact, because it's an electric car, in the first year, it can claim the full cost of the capital cost of the vehicle against its profits, which is absolutely superb. So if you go out and buy a £90,000 Porsche Taycan in your company, you can put that £90,000 against your profits in the year that you buy it, and get a full deduction. And the recipient of that car won't get a huge tax penalty. There was a period a couple of summers ago where I was talking to all my clients about this, and they couldn't wait to get out of the meeting and get themselves down to the Porsche garage to get their Porsche Taycan ordered. And I think I ought to have been on commission for Porsche in Nottingham.
Oh, well, to be honest, I was like, now in this group of the people, I was thinking, oh, well, shall I just, to schedule, my test drive for the electric vehicle car soon. So let me just deep dive in this electric topic, because we have just a bit our meeting going down to the end, and I just would like to understand just a bit more about that. Let me say I'm having my car, and that's a petrol car, and let me say in this year I would like to change a car for electric, which will be cost like, let me say, like 45,000 of pounds precisely. Let me say just. So how much money I can save in a tax if I will transfer my petrol car to the electric car? Precisely with, let me just, give me some clue.
In the first year,
Right.
you would get about £11,000 tax refund. You'd reduce your corporation tax by £11,000 on that car. Now that wouldn't be every year; it's only in the year that you buy it. But the cost of that would be fully deductible, and so 25%, which is around £11,000, which is brilliant.
Yeah. And what about the next years?
Well, after that, you don't get anything on the vehicle. You only get the running cost of the vehicle. But again, at least they're being put through the business,
yes,
and you're claiming tax relief on it.
Oh wow, that's really exciting, isn't it? Hopefully the Great Britain will heard about this exciting news, and they will use that to save our planet. Right. So, Jason, I just would like to probably to finish our podcast for today, because we have a lot of questions there. They're still waiting for you. But I think that's the time just to say goodbye to our listeners for today, and probably to make an announce for the next our podcast. So as far as I understand, you are going to make this podcast regularly, kind of a weekly or monthly. So what is your idea about that?
Probably every couple of weeks would be fair. We don't want to bore people with this sort of, even though I find it fascinating. I know that everyone doesn't want to hear from an accountant every week. So yeah, maybe every couple of weeks. But we really want that content from our clients. We really want and prospects. We really want to know what questions you want to know the answer to. How about this for a challenge? Try and come up with a question that no one has asked me before.
Oh, that sounds nice. Let's try to do that. Okay, so guys, thank you very much to be with us today. Jason, thank you very much for your knowledge and for the sharing with us such brilliant ideas. That's absolutely a big treasure for everybody, I think, who are listening us today. And just follow us in our social media. Yep, and all the description will be in our podcast platform. And I wish you the best on this day. Cheers.
Yes, and if you'd like to leave us a review, a like, and even subscribe, then we'd love that.
Yeah, brilliant. Thank you very much, Jason. Have a lovely day.
And you, bye.
Yeah, bye.